What's going to come after this peak, Bill?
In the next 10 to 15 years, there will probably be three bear markets. It took three bear markets to cure the go-go 60s. The bear market of 2930 is legendarily a legendary bludgeoning.
Bill Smead joins us once again. He is a founder and chairman of Smead Capital Management. He was on the show a couple of months ago calling for a potential reckoning in the economy and the markets. Click on the link down below or up here to view Bill's last interview with me and revisit his views. But for now, let's follow up and get his updates. Bill, welcome back.
Thanks for having us.
Oh, it's always a pleasure to speak with you, Bill. Let's talk about takeaways from the Berkshire Hathaway meeting that you just attended. So before we get into that, actually, I was reading the Financial Times, and it was disclosed that they added a lot more cash. The company on Saturday disclosed it had just sold under $20 billion worth of stocks in the first 3 months of the year, buying $2.7 billion over the same period. As a result, the value of its stock portfolio slipped to $336 billion from $354 billion at year end, which means that their cash pile swelled up to a record $189 billion in the first quarter, the largest on record. Does this mean anything?
Well, sure it does. You have two major forces at work here. One is what Buffett and Munger have talked about a lot the last 10 to 15 years, that their size limits their opportunities. They've talked about it all along. We're not going to be able to earn as higher returns as we have in the past because there is a limited pool of companies that are large enough to be of interest to them. And then in this particular meeting, going into it, his letter to shareholders at Berkshire Hathaway, he said a year ago at the annual meeting, he said the types of things that we'd want to do have been endlessly picked over. And so I looked back at his letter to shareholders when he ran his partnership in early 69. He closed the partnership and sent the cash back. And he said, the kind of value investments we like to make have been combed and recombed, which is just another nice way of saying endlessly picked over. So again, a lot of our opinions about where we are from history come to the rhymes that are coming out of 1969.
Okay, but his selling off of of stocks to raise cash, that's not a shift to a more bearish sentiment, or is he just preparing to? Talking about Berkshire Hathaway, are they preparing to just reallocate assets and basically reshuffle their capital?
Buffett is bearish, and he has positioned the company to make large investments at the next point of great distress, be it a '07 to '09 bear market. I think he could look back at May of 2020 and wished he'd been more aggressive at that time. He was in a bit of a COVID-based coma. He didn't allocate more money to his two stock pickers. He didn't buy anything himself, and that was a major whiff. If he'd have put $50 billion into their hands or his hands in their hands and bargains, Berkshire Hathaway would have done even better than it has done. And it's done well. But you're right. His selling, and you just stated, I think the cash position is probably greater than 35% of his portfolio, right? The ones he owned, you said total about 336 billion. His cash position 189. That means that about 35% of his portfolio is in cash right now. And that is a very bearish number.
Are you more bearish right now, Bill? Talking about your views, you told me offline we're shifting towards a new era. What do you mean by that?
Well, what I'm referring to primarily the S&P 500 index, which goes back in measurement to 1926. And there have been four seminal peaks in euphoric enthusiasm for common stocks in those nearly 100 years. It's 98 years since we got Ibbotson numbers on the S&P 500. That would be 1929, 1969, 1999, and today. And in late 21, Charlie Munger said, "This is the biggest financial euphoria episode in my career." And through 21, that was 75 years. So that covers the 69 and the 99 period. So Charlie said that, and it's played out that way in everything but now the Magnificent Seven. Yesterday, I love this. This is a true story. Cole and I in late 21 are at his child's soccer game, and we're sitting with a lady that's telling us how much money she made on Shopify. And the stock was a total glam stock at that point in time. And Cole and I looked at each other and thought about Joe Kennedy having the shoeshine boy give him stock picks in early 29 and causing him to get extremely bearish on the stock market. Well, Shopify has dropped about 80 or 90% since then. And if that lady kept her shares, she's seen all those gains get destroyed. But the Shopifys and the Pelotons and the Beyond Meats and the Zooms and the all these things that were mega glamorous because of being locked up in COVID have been crushed. I mean, crushed and debilitated. And at some point in time, the glamorous largest cap tech stocks will go through that also, just like Coke and Polaroid and Disney did in 1973, 74, just like Amazon and Cisco, Intel, and Microsoft did in 2000 through 2002. It always plays, even if you're going to be a big winner, you do not want to be involved in the late stages of a financial euphoria episode.
How do we know we're in the late stages, though?
Well, you compare the behavior of people with the behavior in the past. So let's take a look. Let's start with 29. RCA was the NVIDIA of 1929. They were the largest maker of radios. They were one of the two largest national broadcasters of radio, and one of the two largest programming or content producers in radio. And in 1923, 1% of American households had a radio. In 1931, 50% had a radio. And in 1937, 75% of Americans had a radio. So just think of the growth. 1% household penetration to 75% in a 14-year time frame. So RCA went crazy and went up 11 times from 27 to 29, $10 to $110.
Right.
And then traded in the 30s between $5 and $10 most of the time. But you didn't want to buy that stock until 1941. And from 41 to 68 was truly the most spectacular stock to own, probably in the entire United States. Because not only did they capture all the success of the radio business, but they captured all the success of the development of television right along with it. But what's the point? So then fast forward to 72, the bull market of the go-go 60s got elongated by a list of 24 companies that were in both the Nifty 50 lists, which was Kidder Peabody and Morgan Guarantee. Each had a Nifty 50 list, but 24 stocks were on both lists, and they were the heart and soul. They were the magnificent 24, you could call them, of the 71, 72 bull market. And that got crushed in the 73, 74 bear market. And I started in the investment business in 1981. My first stock pitch was Coca-Cola at 6 times earnings, paying a 5% dividend. And Coca-Cola was 60 times earnings at the end of 1972. So they had a 90% PE contraction in that time period. Mm-hmm. Okay. So in 99, Munger was quoted as saying, when you combine a euphoria episode, which is like a chain letter or a Ponzi scheme, with a legitimate business development, right? That's his quote, a legitimate development. So was radio a legitimate development? Yes. Was what Disney did and Coca-Cola did and what Kodak did and what Polaroid did, was that a legitimate business development? Yes. What was the internet going to change our lives? Was that a legitimate business development? Completely, absolutely true. Absolutely true. And is AI going to be a very legitimate, huge business development? Absolutely true, except the explosive excitement related to that is synonymous with the three prior peaks in interest in the stock market.
Before we continue with the interview, let me tell you about today's sponsor, Brain FM. Now ask yourself, are you happy with your ability to focus on work, or do you think that your brain is capable of more? Well, improving your concentration at work can boost your productivity and perhaps even your paycheck. But you can't easily focus if you're constantly distracted by emails, phone calls, and other tasks, which ruin your concentration and cause you to fall behind at work. There is a scientific solution to all this, and it doesn't involve pills or other medical interventions. That solution is Brain FM. Now, Brain FM plays music that helps you work better, stimulating your brain and helping you avoid distractions. I use Brain FM to help me focus when I'm researching or preparing for interviews, prepping scripts and whatnot. Using music to help with productivity is the only reason I can be consistent with the videos that you're seeing me upload on a daily basis. Backed up by the National Science Foundation, Brain FM's music contains patented brainwave technology, which optimizes your brain patterns for intense and focused performance. You can choose from multiple genres of music, including classical, lo-fi, and even nature sounds. Brain FM even has a mode specifically designed for those who suffer from ADHD. And now you can get a full month of free access by just going to brain.fm/David Lin in the link down below, or scan the QR code here to get Brain FM for free. You have nothing to lose, and if you don't like it after a month, then you can always cancel. Try Brain FM and boost your productivity today. Yeah, so the hype in AI right now, how do we know that is legitimate hype and not just overhype and overvaluation in these stocks?
Well, it could be overhype. Buffett said that he thought it might be as good for bad reasons. Or, I mean, it might be as exciting for scamming as it is for the good reasons.
That's right. He's not invested in AI. He said he doesn't understand it, but he also said the same thing about Apple before he bought it, and now it's his biggest holding.
No, that's right. In other words,
yeah,
we as a company are in the camp that the internet did change our life, and AI is. If Jamie Dimon says it's an important thing, we trust Jamie Dimon. We've been invested with him since the whale trade in 2012, and I admire the guy a lot. And so I'm going to trust him that it is a very legitimate business development. But the problem is the hype gets front loaded, and the answer to your question is common stock ownership as a direct and indirectly has broken the 99 record and the 29 record and the 69 record. In other words, Americans as a group have a larger percentage. This is Federal Reserve Z1 report, right? So this is the federal government putting the statistic out. It's the highest percentage of household assets in the United States ever. And Charlie's right. It peaked in November of 21. So the problem is you have to ask yourself this question. In the scheme of history, is there ever a society that God put on this planet just to all get rich together in the stock market? In other words, is that the purpose of life, to get rich in the stock market together? Well, all recorded history it shows that in all civilized nations, there are peaks in that and there are valleys in that.
Yeah.
And we're very close to a peak. And that's why Buffett's selling. That's why he's building up a massive cash position, because he knows that there are going to be times in the future that are better deploy that capital.
What's going to come after this peak, Bill?
Well, there will probably be, I would guess, in the next 10 to 15 years, there will probably be 3 bear markets. And I say that because we had a 73, 74 bear market. And then There was another bear market in the later 70s, and then my first 2 years in the investment business, the Dow went from 1,000 down to 776 on August the 5th of 1982, when the bull market took off. It took three bear markets to cure the go-go 60s. The bear market of 2930 is legendarily a legendary bludgeoning, and really the market never took off until we won the Battle of Midway in 1942.
Right. So how does this bear market look? Are we talking about like in the 30s where we had the 20, pretty much a 20-year stagnation where we didn't have new highs until, like you said, after World War II? Or are we getting just minor bear markets in the context of a bigger bull market like 2020, for example, when the pandemic hit? That was a bear market, major, but it rebounded. It was a context of a larger bull market that extended from 2009 till now.
I think you just went right past my pay grade with that question. No, but
nobody knows. We're speculating.
Yeah, let me explain it to you this way. I think you could go back and look, and the 73-74 bear market was probably the only two bear markets that compare. The worst of all was the 2930.
Yeah,
that was the worst of all. That was like a 90%er. But the tie for the two second worst were 07 to 09 and 73-74. So Buffett closed his partnership at the end of 68, and he was interviewed in Forbes in 1974 near the bottom, and they asked him what he thought of the market, and he says, I feel like an oversexed man in a harem. Okay. There were lots of bargains by then. Okay. So, but a bull market in stocks that took hold didn't start till mid to late 82. Right. And so that's the problem. The problem is, how long was it before people got enamored of the things that were the glam stocks in 1972? And that took a lot longer. I paid 15 right after the 9/11 attacks. There was 17 days you couldn't fly. So obviously the parks just stopped, right? The Disney parks were considered a terrorist target.
Okay.
And so you couldn't fly and no one went to the parks. And I remember buying Disney stock at $15 a share. You had another chance to buy Disney shares at the bottom in 08 at $15.
Yeah.
7 years later. And that's the way these things play out. In other words, yes, there'll be bargains after the first bear market, but now here's the other difference in this circumstance from 29, 69, and 99. Investing in common stocks in the United States. Jack Bogle said 2 years before he dies, I hope I haven't created a monster. And the participation in the United States stock market is completely dominated by passive and mostly S&P 500 index passive. So the problem with this next set of bear markets in the next 10 to 15 years is, if you are a large cap stock in the S&P 500 index and the S&P 500 index gets net liquidated off and on for the next 10 to 15 years, you're going to see Berkshire Hathaway do worse than it used to do, because it's a large S&P 500 stock that's being automatically net liquidated because of how big it is in that index.
Wait a minute. How can you explain, how is an index fund like Vanguard, or you're talking about Bogle, how is that a monster? What is he doing?
Bogle thought it was becoming a monster because it was being overly adopted.
Okay.
So there's two ways it's a monster. It became a momentum investment. See, David, any good investment discipline can go sour when virtually everyone decides it's a good idea. So let me give you an example. Buffett wrote in 67 that the kind of quantitative ideas in value that he had feasted on from the time he got out of Ben Graham's school and started his original partnerships up until 1968, he'd feasted on quantitative ideas, paying 30 cents for a company that could be liquidated for $1 over and over again. Quantitative value. And he met Charlie and he switched to qualitative value. And he wrote about that. He said, I'm going to have to use more qualitative ideas, and that those good ideas will be fewer and farther between. Now, from late 69 until about right now, everyone has decided that those qualitative, wonderful, wide moat, monopoly, strong balance sheet companies are the thing you absolutely have to do. Right? Everyone, you look like an idiot if you have attempted to create a track record of common stock ownership without first the FANGs and now the Magnificent Seven, because they have wide moats and they fit the characteristics of what Munger convinced Buffett he had to do. Costco trades at 45 times earnings. And for the first 25 years of its existence, it never got higher than a 20 multiple as a mature business. But now all of a sudden, at the size it is now, it's got a 45 multiple. That's maniacal behavior right there at its finest. Costco is unlikely to grow as fast the next 10 years as it did the last 10 years when they were a much smaller entity. It's just simple mathematics.
Yeah.
Right?
Yeah.
Okay, but people have been overpaying for quality because it was the right thing to do the last 10 to 15 years. And the bear market of the next 10 to 15 years will punish that, because when everybody knows you should do something and everybody does it, there isn't anybody left to put money in.
Well,
Where's the capital going to come from to perpetuate that scheme?
All right, so let's talk about how you use PE multiples. Let's say you got two companies, peers in the same group, doesn't matter what sector. One is trading at a considerably higher multiple than the other, but the higher multiple company is considered a higher quality business, like you were just alluding to. Okay, what do you do in that situation? Do you bet on the higher quality one to outcompete the competitors, even though it's more expensive?
As a buyer, and this is not as a holder, but as a buyer. As a buyer, you want to buy an outstanding business when it's deep in the doghouse. Okay. So some of my friends in the value camp were wise enough to pick up what I call the alias companies, Google and Facebook, when they were depressed at the end of 22. And I tip my cap to them. Now, the truth of it is, I don't trust either of those companies farther than I can throw them. I think at the heart of their monopoly and at the heart of their money-making ability, I don't like what they do the same way I didn't ever own Philip Morris. Okay. I don't like the companies. Okay. Are they smart investments the last 10 years? Absolutely. Okay. So that's been cured, right? We've cured that depressed stock prices of the end of 2022 in those guys. So I admire people that can shift gears around like that. But the problem is you've got to have someone behind you come in and want to pay for those things after you. And there's no one left to get in those things. Once the value guys own a bunch of growth stocks, you know it's time to shift gears.
How do you know that something isn't a value trap if it's really cheap?
You don't. You buy you buy 10 of them knowing that you're going to be dead wrong about probably about 3 or 4 of them. But again, so let me give you an example of something happened here recently. I've been a big fan for a long time of Merck and Amgen.
Yeah, that was one of your top holdings, by the way, in your
because their most important long-term investment is R&D, and it comes right off the top as an annual expense. Well, in most companies, let's say your Caterpillar, your plant and equipment you depreciate over a number of years, right? Your most important long-term investment only hits your income statement in the form of depreciation. Okay. Whereas in the drug business or the biologics that Amgen does, they take those important investments and give their gross revenue a 18 to 20% haircut every year. So when they report after-tax profits, they have given themselves a voluntary pre-tax haircut of 18%. They're much more profitable than what they're showing. Now, the market worries about them because they question whether that 18% of gross revenue will produce blockbusters in the future the same way it did in the past. Now, Merck has been doing it for 105 years, and Amgen's been doing it for 65 years. The market has more confidence in Apple to bring out a new whiz-bang iPad every 3 or 4 years than they do Merck and Amgen to bring out a blockbuster medicine. Because that's what they...
The R&D... Yeah, sorry, I was going to say the R&D could also be capitalized, right? It could be listed as an asset.
That's right.
Yeah, so
that's right. That's right.
That could also boost valuations in some way. Okay. So you like, let's go over some of the sectors you like, because you wrote in the notes sent to me that we should find things that are outside this euphoria, right? Yeah. Good companies, legitimate businesses outside this euphoria. What sectors are we talking about, Bill?
Well, Cole had me read a book the other day. It's really good. It's T. Rowe Price by Cornelius Bond. And I didn't know the story of T. Rowe Price. I knew it's a great company, right? That has been maybe from investor standpoint, the most successful publicly traded money management company ever. So T. Rowe Price started out like he started out as an investment counselor. He was like an RIA for 15 years. Then he started a company and put that RIA business in there. Then he started funds. And so then in 1968, he saw the massive amount of money borrowed to fight the Vietnam War and do Johnson's Great Society legislation to expand federal government welfare, and got very troubled. He put oil and gas stocks into his growth fund, and he started a brand new fund called the T. Rowe Price New Era Fund to own oil and gas, commodities, and gold. He became a big gold bug. Well, here's what's ironic about reading that book. This was in 68, 69. He was the most respected growth guy in the United States of America in 1968. He had the best growth record of anybody. And he came to the same conclusion as Warren Buffett did, who closed his partnership at the end of 68, gave the money back, who was the best value guy of the prior 20 years. So the best growth guy and the best value guy came to the same conclusion at the same time. And I thought, wow, that is powerful, right? Two guys coming from completely different predilections on what they think is important came to the same conclusion. This monetized debt was going to chase too few goods. We were going to have a miserable inflationary decade, and I better deal with it. Both of them dealt with it. Okay, so where are we now? The money borrowed to fight COVID makes the Vietnam War relative to total government borrowing and the GDP of the United States look like chump change. And we suppressed fossil fuel work for 5 years. John Kerry and Al Gore went around the world generating power way bigger than being president of the United States by creating a religion around stopping fossil fuels. Like we have a usage fund. You go to Europe and 70% of the large money pools won't even talk to us because we own oil and gas companies, right? We're like a black sheep. So what is going to happen is the single best industry in the United States of America over the next 10 years is going to be creating fossil fuels.
Really? Okay.
The price of fossil fuels is going up and up and up because AI is going to use electricity like you can't believe. I mean, and data centers use electricity. Go to George Gilder's book, Life After Google. He starts it out by pointing out that Google put a huge server farm next to the Dalles Dam on the Columbia River near where I grew up.
Yeah.
Because that's where the aluminum smelter guys used to be. Because the closer to the dam you are, the cheaper the electricity is.
Well, that's my next question. Why fossil fuels in particular then? Why can't it be hydro, right? Dams. Why can't it be solar? Why can't it be nuclear?
Because on the Columbia River, the environmentalists in the Pacific Northwest are trying to tear those dams down to save the salmon runs, but they don't want to kill the 1,000 or 2,000 misplaced California sea lions sitting on the dock in Astoria, Oregon, that the average sea lion eats 2,000 pounds of salmon a year. So they won't get rid of the unnatural species that has moved up there that has no natural predator, by the way, which would do more for the salmon runs than any dam you could pull off. So we won't build nuclear plants because it's not in my backyard. We're not building new dams because there's no new rivers. Wind and solar work sometimes, don't work other times, and can't aggregate. And we're eliminating the 19.5% we were doing in coal-fired plants, which, by the way, is the main way you make electricity in China, India, Japan, and Germany.
Well, then I guess you're bullish on energy. AI, how do you invest in AI?
I think energy is the best way to invest in AI. In fact, I think natural gas, we make 40% of our electricity out of natural gas. There's been a glut of natural gas because of all the oil we've produced, but at some point in time, over the next 10 to 15 years, the use of natural gas to make electricity, it's the cleanest, it's the cleanest of the fossil fuels. I mean, I feel like I'm channeling Boone Pickens or something here.
How do you feel about home builders? Are we seeing a supply shortage of homes right now?
Yeah. So a lot of people ask me how you think the federal government's going to deal with the deficits. And I said, well, there's three possibilities. One possibility is to raise taxes.
Yeah.
But we learned in the 70s and 80s that the higher the tax rate gets, the more skilled, way above average income people get at dodging taxes through tax shelters and other mechanisms. So that never works, right? People they figure out a way to avoid them. You could cut spending, but that only ever happened in the movie called Dave. Have you ever seen the movie Dave?
No, I haven't.
Okay, Dave is the story. The president of the United States has a stroke. Mm-hmm. His handlers put him in a hospital set up underneath the White House.
Yeah.
And they go find a guy named Dave, who is a doppelganger to the president of the United States. Kevin Kline is the actor. And they bring him in to stand in for the president. And then the handlers that were handling the president tell everybody what to do. Okay. So Dave, the stand-in president, finally gets sick of the handlers and brings his accountant in from Boston, and they go through the federal budget and cut the budget 3% across the board. And that's the only time the federal government budget's been cut in the last 40 years is in the movie Dave. That ain't going to happen. The third way is the way we always do it. The way we always solve too much borrowing on the federal government level is to end up paying it back in dramatically cheaper dollars. In other words, we inflate our way out of the problem.
Okay.
If inflation runs 5% a year for 14 years, right?
Yeah.
You pay this debt back in 50-cent dollars.
Right. Okay. But we don't have 5% inflation today. Is that going to be a problem going forward?
That's because we haven't had the next wave in the energy business, and it's coming.
Energy is going to hit first, and then inflation is going to follow. That's what you're saying.
And energy is the most important for psychological reasons. It what you pay at the gas pump is the one thing that almost everybody in our society does every couple of weeks or week,
Yeah.
and therefore it's the American public's measurement tool for understanding inflation. Now, they don't look at what they're paying at their favorite restaurants or fast food places
Right.
and compare that to what they paid 6 months ago.
Yeah.
Because if they did, they'd realize we have a lot more than 3% inflation right now. Every restaurant or fast food place I go to is trying to find decent labor at $20 an hour, and that number is going to go to 25 or 30 to find the labor.
Okay. You haven't cited war as a reason to buy oil. Geopolitical shocks aren't important here. It's not the reason.
Well, let's face it. There's. Let's just say this:
Yeah.
we're in deglobalization, and when you deglobalize, you send prices higher, right? Amazon got rich selling cheap Chinese-made goods to your door. That's over. And
Wait, sorry, what do you
the
mean what do you mean it's over?
it's
I'm
over.
still getting the cheap Chinese goods from Amazon.
Well, no, you're getting the cheap Chinese goods, but you're not going to pay. You're not going to be getting your semiconductors from Taiwan Semiconductor in Taiwan.
Hmm.
Biden has given them $5 billion to build them right here in Phoenix, Arizona. And Intel, $10 billion is being pumped into the local economy so that we can make the chips here. And this metropolitan area is already one of the fastest growing places in the country and being affected by inflation greatly by a massive influx of people. And they're going to pile in $10 billion on top of that.
Yeah.
Just to make sure we get plenty of inflation locally.
When do you think this inflation wave is going to hit again? I ask because the Fed's looking at inflation this year, right? So is it going to be this year, next year? It's going to affect monetary policy.
Yes. If you go back and look at what happened in the 70s,
Yes.
Inflation got to 6%, and the bear market of 69, 70, and the recession dropped it back from 6 to 3. Then it went from 3 to 11, and then the bear market and so forth pulled it back to about 5, and then it went to 14. And finally, the combination of 2 or 3 recessions, we had another recession in 81, 82, and the tight money policy. I sold someone a 15% 90-day T-bill. I'm sorry, an 18% 90-day T-bill, and long bonds were 15% in 1981. So, yes, that killed the economy, and that killed the inflation, combined with President Reagan standing up to a powerful union, the air traffic control union, and basically said, if you guys go on strike, we're going to hire new air traffic controllers. And he did. So between Volcker and Reagan, they put a psychological break point on the inflation. There has been no psychological break point put in place whatsoever. One of the people running for president is out there telling the labor unions he'll give them whatever they want. That is not how you break the back of inflation. You don't break the back of inflation by having California raise their minimum wage to a audacious number in relation to the rest of the country. That's not how you end inflation. You don't end inflation by suppressing, allowing oil and gas companies to find more resources for you. You limit the supply. So it's the game is on. Off and on over the next 10 years, inflation is going to be the number one economic problem in the United States of America.
So bottom line for this year, then, you don't think inflation is going to come down significantly? The Fed's going to keep rates higher for longer? Can we summarize that view?
No, the Fed will pack it in at some point, regardless of whether inflation goes below 3. And by the way, to get to 3 right now, they're using the core thing.
Sure. Yeah.
The core stands for the price of everything that aren't the most important. That's what that stands for. Right.
Yeah.
I mean, it's just crazy. So again,
well, they do that to remove the seasonal factors of oil, but I get your point. Yeah.
Yeah.
But
By the way, what does Buffett and Munger call EBITDA? Earnings before everything that matters,
Oh yeah.
right? Yeah, it's the same thing with the inflation statistics. Yeah, this is the inflation rate before you count everything that matters. Uh, so, so here's an easy way to think about it. In 1963, CBS started their first goofy comedy series. Uh, it was about a guy in the Southeast that was hunting for food, and he found oil on his property, and his relatives convinced him to move to Beverly Hills, called Beverly Hillbillies. That was in 1963. The oil business peaked when Who Shot JR was the third most popular episode of a TV show in the history of the United States. That was in 1981. So the oil business had a great run from 1963 to 1981. This time, the run in the oil business started at the bottom when the Saudi Sunday, they took the price negative for one day. That was 1963.
Okay. Finish off on financials. Now, I noticed you added a few regional banks in the last
Yes.
quarter. Tell us about your
Yes.
decision there.
The decision there was we look we did not get involved in the complete meltdown in March and April. Uh, that's not our modus operandi. On an individual stock, we'll get involved in a meltdown when JP Morgan went from 53 to 34.50 on the whale trade, and Jamie Dimon stepped in, bought 3 million shares at 34.50. We got involved. But normally on a whole sector, we don't necessarily get involved. But by early November, we had identified 3 companies that we thought were boring enough and had some insider buying that we could get involved in. But we now run a $6 billion mutual fund, and you can't just dump. If I buy a 3% position now, I'm buying $180 million worth of stock, and you just can't go into a $3 billion market cap regional bank and dump $180 million into it quickly without jacking the price around yourself.
Sure.
So we decided to buy 3 1% positions to get the money in there without disturbing the prices very much.
Okay, well, I have to ask you because you bought this before Republic First from Pennsylvania, Philadelphia failed, right? So now that heightened fears, renewed fears of bank failures are hitting headlines again. Is that going to change? Let's evaluate that. Do you think that there's going to be more regional bank failures? Number one, and if so, will that change your positioning?
Uh, no, what we think is going to happen is the next bank failures are when everybody that hasn't admits the disaster area in downtown office buildings in the major U.S. cities.
Okay.
So when we chose the 3 regionals we tried to get away from office buildings in major cities. Amazon owns 22 skyscrapers in downtown Seattle. Many of them they built at the height of the bubble. Between 2017, 2021, more skyscrapers were built in Seattle, Washington than any single town in the United States, even though it's only the 18th largest city in America. Okay.
Yeah.
So somebody has loaned the money on those, and then somebody owns the buildings. So the equity is gone for whoever owns the ones that have loans attached to them. But if Amazon paid cash for them, they got to write those suckers down. And they haven't, because no one's being honest about what's going on in that sector, except for people that are handing the keys back to the banks and saying, look, we're washing our hands of these things. So you have to be real careful with banks that have loans on these office properties that we don't ever see going back to what they once were. And then just look at Starbucks. Here's a perfect example. Starbucks feasted on the employees that filled skyscrapers in major cities. We own Starbucks. That was our most successful stock from 2009 to 2012. We bought a lot of that during the 2008, 2009 bear market. But now, how well are they going to do when 40% of the people go to their office building in downtown Seattle versus 80%, right? They lost half their customers in their downtown stores. And that's true of every major city. Chicago, who wants to go to downtown Chicago to get their Starbucks? So that is a huge factor. It's part of why we like our mall REITs. The 45 minutes away from downtown, you got a customer.
Yeah. Okay, Bill, great thoughts. Let's wrap it up here. Where can we learn more from you and Smead Capital? Yeah.
Smeadcap.com. Our advice, podcast, a book with legs, missives almost every week. We've written for years, and Smeadcap.com is the place to go.
Perfect. We'll put the links down in the description below, so make sure to check out Smeadcap.com and follow Bill in those links. Thank you very much for joining us today. We'll speak again soon.
Thank you for having us.
Yeah, for
Thank
sure.
you.
And
Pleasure.
Thank you for watching. Don't forget to like and subscribe.